We're half an hour away from the opens in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Annabelle Droulers with David Ingles.
Let's get to your top stories today. Stocks across the Asia-Pacific extending the gains we saw on Wall Street with those U.S. inflation numbers coming in, or at least cementing these expectations for a Fed rate cut next week.
Chinese state media backing a stable yuan after a report that Beijing may allow a weaker currency in response to a potential U.S. trade war.
And Donald Trump reportedly reaching out to President Xi Jinping even as he threatens tariffs, inviting the Chinese leader to his inauguration next month.
Taking a look at the market action this morning, and this is well and truly the reaction we're getting to the U.S. inflation print overnight, pretty much meeting economists' expectations, and that potentially sets us up for a year-end rally. U.S. futures are a little bit under pressure so far. Most of the action came through in the NASDAQ overnight. We actually saw it hitting a fresh record high for the year, up nearly 2%. Yields as well, we were keeping a track on those overnight. We did see them moving a little bit higher again, this changing expectation, or pretty much cementing the Fed decision next week. In terms of what we're watching in Asia this morning, again, we are just seeing equities moving higher here across the board, really tracking Korea very closely. We've just been hearing from Yoon this morning, just in the last few minutes, essentially seeming to offer a little bit of justification for why he issued that martial law decree a few days ago over the weekend. But essentially, that is what we're seeing there. Again, taking a quick look on what Fed pricing is telling us, and it is essentially saying that we've got that 25 basis point cut very much baked in at this point in time. You're still seeing around a 50 basis points of easing between now and May of next year. Golden Dragon Index to note as well, because we did see that momentum continuing to lose a bit of steam overnight, because we had, of course, the Politburo earlier this week issuing this big decree saying they're going to be loosening monetary policy, also trying to boost consumption, taking a look at what the Golden Dragon Index did. But again, it seems like investors are really not taking too much heart into what policymakers are saying, and essentially really trying to look for further details. How we're setting up for Chinese futures as well to note ahead of the open in the session today. Watching the yuan very closely, of course, given you've got Chinese policymakers, well, Reuters reporting at least that they're willing to allow it to weaken, all to try and react to that incoming or upcoming possible Trump tariff trade war. Dave?
Yeah, and I think the other side to that report on this sort of one direction narrative on the Chinese currency is this PBOC-backed paper talking about how it's a two-way bet. You know, don't get your expectations only one-sided at this point in time, which we'll get to in a moment. But let me just pivot and have a look at another currency we're tracking at this point in time. So we're getting some weakness coming through in the South Korean currency. The equity market, which was up as much as over 1%, has paired those gains on the back of many of these lines coming through in this address coming out of President Yoon in South Korea. One of the lines coming through there is that he will fight until the last minute. Let's get more context and detail on these lines coming through out of South Korea with our Asia trade co-anchor, Sherry An, who's been covering the story from the get-go in Seoul for us. Yeah, Sherry, give us a context. Where is he speaking and what has he been saying?
We are seeing this taped address by President Yoon right now, and he's sort of giving his reasons for having declared martial law in the country, that shock martial law declaration last week. He's really blaming it all on the opposition party, saying that they were threatening national security, social safety as well, that they're actually taking North Korea's side. He's saying that he actually tried to defend and protect liberal democracy and constitutional order, and as you said, that he will fight until the last minute. We had seen indications that perhaps President Yoon was hoping to stay because we had seen reports that he wanted to be impeached rather than exit by himself, something that was confirmed earlier by the ruling party leader Han Dong-hoon, now coming out and saying that he's confirmed that Yoon will not be exiting early, that impeachment is the only way forward, that they need to penalize Yoon. And remember, it was because the opposition couldn't get get enough ruling lawmaker votes that impeachment did not happen last weekend. Are we going to finally see that impeachment bill passed? The expectation is for a motion to be filed as early as this week by the opposition, and perhaps we could get another vote on Saturday.
And based on how it seems like maybe politicians are changing their mindset, do you think that we could get a different outcome this time around?
We have heard from local media that 6 ruling lawmakers may be voting for impeachment this time around. It's a little bit of a question of how this could unfold. I mean, President Yoon clearly does not want to resign. A lot of politicians right now are getting pressure from family, friends, acquaintances through messages, through social media that they should impeach President Yoon. So if the president doesn't want to resign, if he actually prefers impeachment, does that mean that the ruling party will actually end up voting for impeachment? Of course, the key question. And what happens next is that this would go to the Constitutional Court. Some local media now saying that perhaps this is what President Yoon wants. He wants to buy time, and he also wants to have an opportunity to explain himself like he's doing right now through that taped message. If that happens and the Constitutional Court either upholds the impeachment bill or votes down, it's a different issue. If they uphold it, then within 60 days, South Korea needs to hold another election.
Sherry, just judging by market reaction, weakness in the currency, the equity markets giving up some of the gains, most of the gains from early on, I guess the question right now is, are we any closer to either certainty or conclusion nearly a week on from what's going on there?
No, definitely, most likely, no conclusion in the next few months, because we still have an impeachment vote. If it doesn't get impeached, there will be calls for his resignation. If he stands firm, that will take time. The Constitutional Court needs to get to a decision within 180 days. Then there could be another election within 60 days, so this could drag on. In the meantime, yes, there's been a lot of volatility in the markets, but they seem to have sort of recovered, right? I mean, we are talking about 3 sessions of gains for Korean stocks now. The Korean won also fluctuating, but still broadly in line with where we've been the entire week. We had some pressure from the offshore yuan, but the yuan is a whole different story right there. Nomura now saying that the economy could be suffering a 0.2% hit if this political uncertainty continues for several months. And the finance minister here in South Korea now also warning of downside risks. So we'll continue to just watch the latest political developments.
Sherry, An and the team there, fantastic coverage. Our co-anchor in Seoul for us all week on this story. From this to China right now and the agenda going into the session today, where potentially, and the next catalyst could actually come over the next, and I say potentially over the next 12 hours or so, this potential readout from the Central Economic Work Conference, the renminbi fix, and we'll talk about really the context here on the currency, given tariffs, given what some of the reporting out there is suggesting the direction of the currency to be. You look at the spread between forwards, between onshore and offshore, do indicate some weakness ahead. We'll get to the stocks to watch in just a moment. In terms of data coming through, PPI, industrial production out of Hong Kong, and potentially FDI and credit data out of mainland China. Bill.
Yeah, the yuan fix really taking on a greater importance in the session today. But a quick look as well at what Chinese state media is saying on the economy. Real focus coming down to the Central Economic Work Conference that is wrapping up today on Thursday. Question, of course, what we get out of it. But in terms of what we're seeing, the official Xinhua news agency is criticising what it says is a misguided belief in the West that China's response to its challenges is inadequate. It says those that are holding the view will find themselves on the wrong side of the story. Xinhua also says that China is set to wrap up a challenging year with its growth target set to be met. We know that's around 5%, and more forceful pro-growth policies are in the pipeline. As we await that readout from Beijing, a PBOC newspaper also says there's a solid foundation for the yuan to remain stable. It follows a report that China might allow the currency to weaken next year in response to a potential trade war with the US. Our Chief North Asia correspondent Stephen Ingles is with us, and this is sort of seems to be one of the tools that they could rely on to try and rebuff that threat from the U.S.
Yeah, you want to start with the currency? Because that's the big issue right now. Obviously, There are some tools that they can use, obviously, with some of these export controls on rare earths and on drone components and all this and that. But it's the yuan right now that is clearly in focus. There was the Reuters report from late yesterday that essentially sent base metals down for one, because for one, that would a weaker yuan, if that's what the Chinese authorities want to see, would basically increase their import bill. But also, if you weaken too much, there could be outflows, and that's something that the Chinese leadership does not want. So is there going to be a managed depreciation to what is now about, 7.2829 to the U.S. dollar onshore, to about 7.5 seems to be the consensus that Reuters was reporting. We had a guest on yesterday, I believe, or earlier this morning, I lose track, that said, yeah, 7.5 is probably the right one. That's a managed, depreciation that could give exporters a boost, make exports a little bit cheaper. But again, the PBOC-backed newspaper, Financial News, essentially came out very quickly after that Reuters report hit the markets, and they said stability is key. Don't bet one way on depreciation of the yuan. In fact, that column, which is not really an independent column, it is the mouthpiece, essentially, of the PBOC, saying the RMB has a solid foundation to remain basically stable. In fact, they said the yuan by year's end could actually strengthen because of corporate FX settlements at the end of the year. And the article went on to caution against speculating and hoarding FX in order to avoid suffering additional losses. And you've seen you're absolutely right. The daily fixing is going to become a lot more we're going to have a lot more focus on that daily fixing. They've consistently done it above 7.2 since the election, essentially. They're trying to keep at least the optics that they want to support a stable yuan rather than encourage outflows, obviously.
Interestingly enough, speaking of geopolitics here, the CBS is reporting that well, you probably know where I'm going with this.
Yes, I do. Yeah.
The invitation is out to President Xi Jinping to attend
I've been thinking about this a lot. Absolutely, he won't go, right?
Okay.
But should he? Maybe he should.
That's the thing. Yeah.
Maybe he should go to the inauguration, because
has there been ever, though, a Chinese president that's attended inauguration to your
I'm not a U.S.
recollection?
presidential historian, and I don't think so. No,
I can't remember an instance
not.
as well.
No,
okay.
I'm just kidding. Absolutely not. I mean, it would be strange optics, because Donald Trump has basically approached China with the proverbial iron fist and the velvet glove, right? He on the one hand, he's threatening 60% across-the-board tariffs, threatening a potential trade war, essentially. He's stacked his cabinet with hawks who have basically described China as an adversary, and that there should be decoupling. I'm talking about Marco Rubio as the nominee for Secretary of State, also Mike Waltz as the National Security Advisor. He also picked David Perdue as the ambassador. Yeah. While he's a businessman, so it brings a business approach, so he's not necessarily anti-China, but he's written some things criticizing the way China does business. So he's stacked his cabinet. But on the other hand, he calls Xi Jinping his good friend and admires him leading that nation. So wouldn't it be an interesting twist if Xi Jinping were to go to the inauguration and have that chance? You know, it's usually the Japanese leader is the first one to go to Washington when a new president comes in, and they reaffirm that alliance. What a twist of narrative if Xi Jinping were to accept the invitation and go to Washington. But I do not expect it to happen. Again, at a time when China is using this time to essentially bolster its toolbox for retaliation. So they've already, on the back of these latest moves by the Biden administration, they've opened a probe into NVIDIA. They've essentially banned export of several key minerals in the high-tech space. They've limited sales of key components for drones. But at the same time, this is a different Chinese economy, a much weaker Chinese economy than it was in the first Trump 1.0. So they do not have as many tools in their box right now. And that's why any readout from the Central Economic Work Conference later today would be interesting to read between the lines.
Steve, well, I mean, a lot of people want to know which way Xi would be RSVPing, because that is the most read story on the terminal so far this morning. But that was our Chief North Asia correspondent, Stephen Engel, there. And later in the show, Morgan Stanley is also going to be talking to us about that Central Economic Work Conference. Investors are awaiting a readout from it. Hear why they're expecting the strongest stimulus signals in a decade. And we're counting down to the open of trade in Shanghai, Shenzhen, Hong Kong. We had seen equities sort of losing a bit of momentum. Futures, though, indicating to a slight move higher at the open. More ahead. This is the China Show.
All right, welcome back. Okay, I'm going to have 25 seconds to breeze through three big pieces of news here. The renminbi fixer today is out on the stronger side still compared to estimates. 718.54, that's point number one. Point number two, we have strategists out with their call now for the S&P 500 for next year. The average call is for about 6,600. We can talk about China in a moment. Let me talk about the S&P first. 6,600, 9% upside on average. The bull case is 7,100 on the S&P. The bear case is 6,000. So juxtapose that against this call out of Jefferies, and they potentially see upside of about 30% on MSCI China. They like value. They like revisions. That's the key focus there. And they've laid out as well a couple of preferred sectors. Let's get it up, please, if we can. I won't spend a lot of time on that, but effectively avoid property, avoid consumer. They like most everything else. Sean Taylor joining us right now to give us his take on how U.S. exceptionalism affects the direction of travel in China, whether Jefferies is correct, and the rest of the region, Sean.
Yeah, well, thank you. I mean, I think the biggest challenge for China next year is really going to be what happens after Trump comes in and the tariffs. But I think, you know, we've had two incredibly big policy sort of pivots. One has been in September when the government have said, right, well, we want to deal with the property. It's going to take time. The market ran very, very hard on that, has pulled back sort of a third. And then we've had this new news from the Politburo meeting on Monday where they've said, yes, you know, going to be loosened monetary policy. We haven't had that for over 10 years. And also unconventional fiscal policy. Now, we don't know what that means, but if those things come through, you will get a very, very big rally in China. People are underweight. Imagine what happens if we see an improvement in the economy. But the thing is, most of this would probably come through in the second half of the year. So from now till then, it's going to be very tricky.
So in that interim period, what are you doing then around China?
We're focusing on companies that we're very sure on the earnings, that don't have, haven't run particularly hard. I mean, there's some stocks in the MSCI China that have already gone up 100% this year. So we're taking profits out of them, and we're keeping an option on companies in the insurance sector, in the brokerage sector, because those are the areas, and particularly in mainland China, those are the areas that could have the most upside.
Is that pool of companies where you have respectable visibility on earnings? Is that a growing pool as a percentage of the pie? And I'm wondering how the macro fits into that, you know, that selection pool that you have there.
The tricky thing is that most of the earnings this year has come from the e-commerce, the internet platforms, and it's not come from revenue growth. Revenue growth has been quite sluggish. It's really come from their own doing, you know, not substituting a lot, buying back shares, paying higher dividends. So it's really been capital management. What we haven't yet seen is what the impact will be on the economy. You know, when the economy improves on that. The A share is much more tricky because a third of the A share is related to property. That's been under pressure. A third is related to manufacturing. That's sort of peaking out and could get worse under Trump. And then a third is related to the consumer, which is, as we know, has been under pressure a bit. So we're not seeing the earnings come through in the A share, except in areas of sort of self-sufficiency. So in semis and areas where China's really decoupling from the US.
We've had the Reuters report that the PBOC could be allowing for a weaker currency, and regardless of whether that's true or not, I guess there still is a lot of FX traders out there that are saying we're going to get a weaker currency into next year. Yeah. What sort of impact do you see from that?
Well, I think, you know, I don't think we'll have a one-off devaluation. I mean, even though they could talk about unconventional policy, but I do think we'll probably see the currency slip 3 to 5% over time, and I don't think that is a real problem. You know, depending, I mean, obviously there's those companies we've got to be careful with the dollar earnings, etc. But I think the valuations will, if that's part of a policy that is stimulative, then I think that will be seen as good news rather than bad news.
We've been trying to figure out whether the floor is in. Can we use valuations as a metric to determine whether or not there's a valuation floor here? Let's call it 10 times earnings on MSCI China or onshore markets, for example.
I think we can, but going back to a theory which I've probably talked to you about before, February 21, derating in the market because of the whole regulation issues.
Yeah.
China PE is made up of three things: a third the economy, a third attitude to the private sector and regulation, and a third geopolitics. What the government have done, to me, in my view, is they've put in a floor on that valuation. So at the moment we're on about 9.7, 9.8 times.
Yep.
We do not go back to 8.3 times earnings, in my view, because we know that you talk to the economists. I think you've got Robin on in a second.
Yep.
They're not downgrading GDP as quickly as they were before. So they've put a floor on that GDP figure. What you can't do is put a premium on it now in terms of until we see that growth. Geopolitics, that could change very quickly. And I think the attitude to the private sector and certainly foreign fund managers, particularly in the US, are saying, well, what's the attitude of the private sector? Can these companies generate profits? When you look at some of these e-commerce companies, they have tripled their profits since February 21, but the market's still paying a massive discount for that. But I still think, as an international investor, I want to see more progress on the private sector.
I want to shift now, thinking about progress on the private sector, to Korea, because we have seen, of course, all of the political turmoil there, but the trading action has also just been based on that chaebol discount and the value up program. What is your thinking around that?
Well, we've been underweight Korea, but that's more to do with the sort of cyclical side. Maybe we've been a bit fortunate. But, its semis in the US are coming off. Even though the US is performing well, it's really been the AI stocks and the sort of consumer electronic semis are coming off. DRAM prices and NAND prices are coming down. So we've been a bit cautious there. And we've taken profits in some of our value-up trades, which have announced value-up programs. The problem is the real value is in the holding companies. And the holding companies really, and these are the chaebols, they really depend on the laws changing and inheritance tax changing. And until that happens, we're not going to get that value up. It's going to stay cheap for a while. Saying that, the market has been quite badly punished recently, so it's probably not likely to go down another 10-20%, but it's going to be uncertain and volatile. There will be good opportunities emerge on the stock level from this, but you've got to be very stock specific.
The other extreme in the Asia Pacific is India. I mean, Korea's 8 times earnings. Speaking of 8 times earnings in China, I mean, India's at north of 20%, north of 20 times. I get the structural story is unchanged, but when I look at earnings revisions, they seem to be telling me something else.
Yeah, it's very true. And we've been a lot more cautious on India over the last sort of 3-4 months, as have many foreigners. We've seen about $14 billion of money coming out of India. The GDP number, really showed, a week ago, that GDP is not coming through. And this is because of two things. Monetary policy is too tight, and the fiscal policy, even though the government have said they're only going to spend 4.8% on fiscal, it's actually running at minus 3%. So there's been a sort of stalling of investment in India, and that's definitely coming through to earnings. The area that's hit the worst has been the consumer. The GDP growth is not filtering through to the average person on the street. And until that does, I think India's vulnerable. So we're in safe large caps at the moment. We're not playing mid and small.
Just quickly, the case for US exceptionalism, do you think that that's still intact?
I do, but I think that's also, relatively positive for risk. S&P going up. I don't think the 10-year seems to have come down. We're in a fairly perfect environment at the moment in the US where, everyone's worried about what Trump will do in inflationary, but the inflation seems to be steady as it was today. And the 10 years, at a range where it probably doesn't move that far down, but it's not going to go up to 4.5 to 5 that would worry the equity market. So I think we're in a pretty good sweet spot.
Yeah, there we go. And as we were talking about the projections from analysts on the street, 6,600 is the median here for the S&P. Sean, fantastic to see you. Have a great holidays ahead, and we'll talk to you in the new year. Sean Taylor, the CIO, portfolio manager at Matthews Asia. Right, we're just 3 minutes and 20 seconds away by the time I'm finished with the sentence, away from the opening bell. We're called higher, 0.3%. A couple of things on deck today. Central would be this readout, which we could get today out of the Central Economic Work Conference. Morgan Stanley's Xing joins us on the other side of this break.
Welcome back. You're watching the China Show this morning, and we are counting down to the open of equity markets, but a lot of the focus really coming down to what's the currency doing this morning. We just had the fix coming in stronger than what the survey had been telling us it might be, and we're certainly getting a bit of a pushback coming through as well on this Reuters report that China could be looking to devalue its currency in the face of Trump tariff risks.
Yeah, the PBOC-backed newspaper talking about how it's not a one-way bet. Keep in mind, that's a risk that you run. That you take at your own risk. It's still a two-way bet as far as that's concerned. I mean, a lot of the debate right now is what the change in the monetary policy stance opens up as far as, a lower range on rates, maybe a higher range on the currency, which really, when it comes to fundamental economics. Interestingly enough, as I was looking at my screens right now, the folks at Goldman Sachs, the economics team actually just dropped this in our inboxes right now, and the question they have in this full report, I haven't looked at the full report, disclaimer here, is that top of mind for them is, will China's policy stimulus be enough? And we'll get a better gauge of that from that readout we get later today. Arguably, from September, the change in policy pivot number 1 and policy pivot number 2 from the Politburo this week, arguably this change in the stance and the orientation there is certainly a lot more supportive and committed to a recovery in this economy going into next year. Flip the boards, please, and the open in Hong Kong is, the tailwinds coming through out of Wall Street, not showing up as much in the Chinese equity market. It's definitely showing up in the likes of Japan, for example, but this is certainly a market that's really, I guess to some extent, has been dancing to its own tune. 0.4% on the Hang Seng Tech Index. MSCI China's called about 0.1%. We're range-bound in the opening goings here on the Thursday session. So.
All right, let's get more on this now. Bring in Xing. He's Chief China Economist at Morgan Stanley. And Robin, maybe we can just start with Dave's question there. Okay, yes, it's coming from your peer, Goldman Sachs, but will China's stimulus be enough? And what are you hearing about that question, given you're in Beijing right now and meeting people?
Yes, this is the week you have to be in Beijing with the Politburo meeting, CWC, and the news about Yuan devaluation. The short answer is no. I don't think the round 2 stimulus from the Central Economic Work Conference will be enough to reflate the Chinese economy. No. We think 2024 was the year of understanding, the beginning of reflation in China, but it's going to be a long, long battle. It's going to take several years because 2024 is just understanding deflation is a bad thing. They made the pivot since September. However, if you are in Beijing talking with people, there are so many views still in this old school supply-centric mentality. That is, China need to spend money or government deficit on investment rather than consumption or social safety net. That means 2025, the year of trying. They will try a lot of things. It's not enough, and keep trying. Maybe by the year of 2026, finally, they will find the right dose of policy, a combination of consumption-centric stimulus plus social safety reform. But it's going to take several years for them to reflate.
What's the best case this time next year, Robin?
Well, I would say with the feedback from social dynamics, jobs, labor market, people's expectation on income, it deepened policymakers' understanding of the reflation problem. And finally, they are saying goodbye to this old school supply-centric understanding and try to introduce a big consumption-centric stimulus package, social safety net reform for migrant workers. It's going to cost them about 10 trillion RMB over a 2 years horizon. But it's worth it because it's no longer creating excess capacity. It's going to boost the demand and it's in line with the long-term rebalancing towards consumption, that kind of journey. So that's the best case. By this time next year, with the feedback from social dynamics, they find the right dose of policy. But the base case is they will keep trying with supply-centric policy, including today's CWC. That's probably not enough to reflate in 6 to 12 months.
Well, speaking of supply side, and I want to ask you what this means for the deleveraging campaign, Robin. Your latest note here talks about how the CEWC will send the strongest stimulus tone yet. There was a change in policy in late September, as you point out. There's a change in the monetary policy stance that we noted this week. Does this effectively mean the deleveraging campaign is effectively over, Robin?
Yes, I do agree this tone in Politburo meeting in today's CWC, which you will see a government statement this afternoon. The tone, the language will be quite positive. However, there is no details about the size of the package, about the mix of the stimulus. Usually they will only release these details by March next year. Frankly speaking, I think the package will still be modest. Augmented fiscal deficit will likely rise by 2 trillion RMB. That's only less than 1.5% of GDP. And the mix of it will be still largely supply-centric on infrastructure, on industrial capacity, maybe with a little bit more consumer goods trade-in program covering things like phones, but it's not enough. And back to what you asked, I do believe the deficit expansion and the slightly bigger cash for clunkers for consumers, that's the positive part. But overall, the size and the mix is still not enough to decisively reflate the economy.
What is enough then to decisively reflate the economy? What's it actually going to take?
Well, I think when I was in your Hong Kong studio 2 months ago, right after the Politburo meeting pivot in September, we talked about, yes, they made the pivot, they are trying, but because of the old school thinkings, it is still not the whatever it takes moment. And even fast forward to today, with this super strong language from Politburo meeting, it is still not whatever it takes moment. What would be that moment? I would say the completely shift from investment-centric to social welfare reform for migrant workers, for the lower income population, offering the benefits like schools, hospitals, and public housing. It will cost them 7 to 10 trillion for the benefits itself, plus some programs to reduce the housing inventory. So that's a $1.5 trillion program. That's the whatever it takes moment.
Robin, do you think, and you mentioned social measures earlier on. I want to ask you, I'm not sure if this is an economics question, it's perhaps something more along the lines of sociology, but do you think among policymakers there is an understanding that consumer spending habits of this generation have changed, you think? And, that takes us all to, and sorry, it's a long-winded question. One of the things that you flagged as well is, while the policy stance is as clear as it can get to support the economy, there is still some risk in the implementation. And I'm wondering where along that line, the transmission line, do we need to keep an eye on whether or not this becomes successful or not, Robin?
Yes, the consumer behavior has changed for 2 reasons. One is due to the lack of social benefits. Migrant workers and the lower income population save a lot. This is a precautionary saving. Migrant workers on average save 45% of their income. This is the part they can address it with reforms by providing social benefits to migrant workers to unleash this huge consumption potential. The other problem is the housing downfall. With the negative wealth effect from the declining housing price, people don't want to spend as much as before. That's why the central government also needs to step in, using its own balance sheet to help to reduce this very painful adjustment of the housing market by, say, purchasing these unsold units from developers, reducing the inventory overhang. So for both the social welfare reform and helping developers to reduce the housing inventory, central government can play a role. And if they made that step sometime next year, I would be much more positive on the path of reflation.
Robin, just quickly, you've been mentioning about this shift to whatever it takes or takes mindset. What would actually cause that shift, and could it be something that happens under President Trump next year?
Well, I think that's a good question. Some of your competitors ran the story of the Yuan devaluation. I don't believe it. I think China will focus on domestic demand rather than use decisive, sizable devaluation because it's not worth it. Maybe it could help the exporters a little bit, but it may trigger self-fulfilling capital outflow. That pressure, PBOC knew it. They won't do that sizable devaluation. And by the way, exporters are much better positioned than 6 years ago, the first tariff war back in 2018, because Chinese exporters diversified. Now, U.S. is a smaller market for exporters in China. They are more in emerging markets, and they upgraded from just assembling phones to export robotics and cars. So I don't think they need that sizable devaluation to compensate for tariff. Instead, they need to focus on domestic reflation, how to get consumers to spend again with job creation, with better social safety net, and with the government help to stabilize the housing market. So yes, potentially with the tariff from US, with the job pressure, with the feedback from our social dynamic tracker, maybe policymakers' understanding on deflation will deepen again next year. And that could trigger this right dose of policy, the combination of reform and the consumption-centric stimulus.
Robin, I'll try to get some numbers out of you. I need to focus on the change in policy stance, moderately loosen monetary policy. Markets trying to figure out how low can government bond yields get, number one. And number two, China's traditionally aligned money supply growth with GDP growth. Do you think that changes as well?
Well, I do think the monetary policy tone change is more for forward guidance rather than a complete change of policy trajectory, because China has been cutting rates, injecting liquidity, right. So it has been doing the monetary easing anyway. However, the key here is fiscal policy. Can they widen government deficit? I would say a 4% official budget deficit will be a positive surprise. And with the tone from Politburo meeting 3 days ago, it's very likely they can widen the budget deficit to 4%, the first time ever. Even in the first year of COVID, China only set 3.7% official budget deficit. So 4% is definitely a step forward to try to say goodbye to these old school thinkings. And of course, that's just a small portion of augmented deficit. They have items below the lines, local construction bond, special central treasury. Put them together, I'm talking about 2 trillion RMB expansion of augmented deficit. And I think that part will be more useful than just the monetary policy.
Robin, thank you so much. It's a great day to be in Beijing, as you point out. Chief China economist at Morgan Stanley from our Beijing studios today. Coming up, our team at Bloomberg Intelligence has put out its top 50 companies to watch this year, and we've singled out a few to talk about in a couple of minutes. Welcome back. You're watching The China Show. So our team at Bloomberg Intelligence has compiled this list of the top 50 companies to watch going into next year. That's really out of the 2,000 companies that they follow around the world across really this whole list of sectors. Now, you're looking at some of the companies here in the region that have made the list. Here to talk about one in particular is Patrick Wong, our senior analyst and head of Bloomberg Intelligence here in Hong Kong, and why this Hong Kong developer made the list. How did they make the cut, Patrick?
You see the challenge for the Hong Kong housing market over the past 2-3 years. But having said that, I think Sun Hung Kai this year going to 2025, right, could be a potential one that could outstand other developers. In terms of the home sales, I think the momentum could be pretty strong for them. The thing is they have a really strong pipeline, and that they are targeting like 25 billion Hong Kong for the sales, which we think that will be like 20% higher than that target. So that is driven by a couple of things like the luxury sales momentum for those Sun Hung Kai projects are also picking up a bit. We see some mainland Chinese coming in to buy again, and this is driven by some stimulus that happening over the past couple of months, and then potentially with 2025 as well. And then more importantly, I think for the mass market, we also see the potential catalyst, like the rental is going up quite a lot over the past 2 years, and then now it's also some pent-up demand, and then coming to buy properties again to 2025. So potentially, Sun Hung Kai is also the one having the largest land bank in Hong Kong, so that will be the one really benefit from that trend.
And given we've got the Fed continued to keep easing next year, how's that going to also play into the outlook, do you think?
Yes, I think the market is driven by the interest rate as well, right? So we see Federal Reserve cutting rates by 75 basis points already, and then Hong Kong, the prime lending rate cut 50 basis points already as well. So hopefully next week we will also see another Fed rate cut happening, and then if the prime lending rate also cut further in Hong Kong, that's also supporting the market, because right now I think the important trend is the mass rental yield is close to 4%, and that's also higher than the mortgage rate already. So that is also usually a positive sign to see more end-user demand or even some investment demand to support the housing sales.
And how did, I know you answered part of this already, but how did you guys arrive at this specific company? What does this company have, for example, that many of the other Hong Kong developers perhaps don't quite match up to?
I think for Sun Hung Kai, they have a really strong land bank, honestly, right? So that's the one thing. And then some other developers, I think they have really smaller size of projects, and also some of them, they rush to sell, but they sell at really low prices. Right, so that is also affecting the actual sales for those developers. So that is something that Sun Hung Kai relatively, I think the leverage ratio is relatively low, like roughly 20%. Yep. So that is also really strong to support the home sales strategy.
All right, Patrick Wong there. That was our APAC real estate senior analyst and head of Bloomberg Intelligence in Hong Kong. And you can read the entire Bloomberg Intelligence list. Subscribers can find that on the terminal. It's also available on Bloomberg.com. Now, we've gone from one positive story to one that's a little bit more negative for Hong Kong's property sector. Our attention now on New World Development. It has been a company facing a lot of pressure to manage its finances. We've also seen the recent leadership changes as well. Now to the next test, which could be its perpetual bonds, and there's some $4.5 billion outstanding. Our opinion columnist Shuli Ren joins us this morning. And Shuli, what's sort of prompting these concerns that we might see the perpetual bonds maybe being extended beyond their deadline?
So whether perpetual bond is debt or equity has always been a matter of concern for traders, right? When the times were good, people just treated the perpetual bond as a straight bond. But when times are bad, the companies, they have the right to not call their bonds or even pay their coupons. And then we know time is not doing that great for New World Development. They wanted to sell their assets to beef up their balance sheet, and that asset sale has been quite slow. And then we see that the big commercial real estate sales in the last few months in Hong Kong, we are seeing a lot of very heavily discounted prices. And also, after Adrian Zheng left in late September, New World Development had 2 CEO changes, and both of them are now coming from the Zheng family. And that makes investors very worried that the tycoon family is just going to let go of these developers and let them survive on their own.
We just discussed Sun Hung Kai on one end of the spectrum, and the reason I bring that up is, is there a risk we look at Hong Kong developers in a bucket and compare that to the sort of distressed situation that the mainland developers have found themselves in, for example? Or are those two buckets far apart still?
I think they are a little bit far apart because with the mainland developers, we know they made money in the last 10 years, and their empire was built on the house of cards. Whereas for Hong Kong developers, they are from tycoon families who had made a lot of money over decades, right? And then that is a little bit different in that sense. But the question is whether the parent company, the parent has the incentive, financial incentive interest in propping up the child. That's the issue here.
The issues in facing New World development, but what does that sort of say about Hong Kong's status as a financial centre as a whole?
Yeah, I mean, a New World issue all these bonds in 2019, 21, and 20, right? And that was just a few years ago. And no one ever questioned the family's financial might or any of the Hong Kong names. They were always very prime, very golden. And now people are stepping back and say, well, it is possible that they are not going to make that implicit guarantee of perpetual bonds.
Shuli Ren, thank you so much, our Bloomberg opinion columnist there. And in the next hour, and speaking of bonds and issuing debt, we'll be hearing from Citi, of course, on the outlook for debt issuance and debt sales. Of course, they are the #1 ranked as far as the G3 currency issuances are concerned. Rishi Jalan joins us at those times on your screens. This is The China Show.
You're watching The China Show and sort of talking about what's really at the heart, or one of the issues at the heart of that US-China rivalry, and that comes down to what's happening in the tech space and the advancements that we see and potentially how the US is also trying to restrict China's progress in this area. But we've actually just had Huawei releasing a new phone, the new Mate 70, that's come out, and this is an indication perhaps the moves that we're seeing in terms of progressing to smaller, more advanced technology are stalling a little bit. So last year we actually had the Mate 60, and this essentially we did a tear down of the device, and it was found that they built a processor with the same 7 nanometer technology, and that was a real win for the company because it showed that they'd actually been able to reach that point, and maybe they were around 5 years behind the likes of TSMC in doing so. Now they've just released this new device, and from the Mate 60 to the Mate 70, it's still that same technology, and so it tells us maybe they're stalling a little bit. Yeah,
it's called the Kirin chip. I think, yes, the Kirin chip is built with at 7, which is interesting because that made so much news last year, the teardown. Once we were able to figure out really how, what the chip was in that as well. I can't seem to recall the time difference between when that was, and obviously the narrative here is that the momentum is stalling because we were expecting this specific one to actually show a little bit more advanced technology as far as 5 nanometers is concerned. But, I mean, yeah, but I guess good things take time.
TSMC, I mean, just to put it in sort of context, they came out with a 7 nanometer chip in 2018, and they came out with the second iteration of the product in 2019. So, again, it's just sort of what's that tech leadership looking like, and what's the sort of gap between US and Taiwan versus what's happening in mainland China.
Yeah, well, interesting, too, because Sean Taylor, who joined us earlier on, talked about one sector that is showing some good earnings revisions in China are some of the chip makers as well. So it's all relative. Speaking of chips, we'll keep you abreast of what's taking place in Korea. I'll look at these markets amidst all these headlines coming through out of Seoul. Plenty more ahead on this and more. This is The China Show.
Welcome back to The China Show. Taking a look at the Hong Kong session, half an hour into trading this morning, and it's pretty range-bound, and that's kind of not surprising. You're seeing sort of lower trading volumes as well, but you're probably not going to have too much conviction right now, given we're still awaiting any sort of readout, perhaps, from the Central Economic Work Conference. Yeah, and I think most of the economists that we've talked to so far don't get your hopes up for this specific one, although they could break with tradition, of course, because of the sort of extraordinary situation the economy's in. But tradition has it that, the details of this will actually be more fleshed out in March of next year. All that being said, we do have a lot more certainty on sort of other matters that matter in the world, like the Fed, for example, the US CPI print, which came in overnight, in line with estimates.
There's some changing narratives right now, a bit more complication in South Korea. We'll talk more about that in a moment. Following that address from the president, it's number one. Number two is this Aussie jobs print, which came in 90 minutes back. I think we're going to show you this melt up in yields that we're seeing there, 10 basis points in the 3-year. Repricing around what the RBA might not be able to do, which is cut rates, I think, at the next one, given how strong the jobs data is. Although we do have to emphasize that the jobs number is extremely difficult to predict.
Notoriously volatile.
Yeah.
Not exactly the most trustworthy.
Well, yeah, economists are always wrong on this one.
Yeah.
Not that they're right on everything else, but this one specifically, come on.
It's a wild card.
Yeah. We're just having fun here. This one is almost like you take the darts out and you see where this lands. In any case, of course, markets price with the information they get. That's what we got so far. Asia ex China, Japan is doing well. South Korea is at about the midpoint of this range from today. 0.7 of 1%. We were up as much as 1%. We were down to about 0.1 of 1%. The yield story, 2 and 10, 4.15 and 4.30 on the U.S. 10-year yield. Suffice to say, we'll probably get a late rate cut next week. Out of the Fed, the question is really on Japan following what we've heard so far, and maybe that they're willing to wait, the BOJ. And, of course, also on the Chinese currency, given all the news that's come out from our peers in the industry.
Our peers in the industry, yeah, we've been watching the yuan after reports from Reuters that Beijing may allow the currency to weaken ahead of a potential trade war with the US. Let's get more on that now, bring in our Bloomberg Intelligence Chief Asia FX and Rate Strategist, Stephen Xu. And Stephen, we knew that off the back of this report it was going to put even more attention onto the fixing. And so what did you make out of the fixing today, that report, and the market reaction we're seeing?
I think firstly, as you guys have mentioned, it's from our peers, so we have to be careful. But even if that's the intention of China, I think there are two angles that we can look at it. The first one, it's actually basically what we already know. Because we know next year we're probably going to face U.S. trade war 2.0. The Fed may not be able to cut, so a strong dollar backdrop. So the yuan basically is going to have to weaken regardless of whether China say or not. So now they say first they want market to be prepared, because eventually when the dollar gets so strong, the rest of the basket in the yuan basket are going to weaken so much that the yuan basket will be too strong. Yeah. And China, we just have to let fixing go, just like what we have saw over the last few years. So eventually the yuan will weaken. It's something that we already know. Level-wise, let's not be too aggressive. I think the last time during the last trade war, the offshore yuan down by over 13%. Even half of that would bring us to 7.5, 7.6, and even closer to parity to the Hong Kong dollar. So I think China is just trying to let market prepare for that. Now that's the best case scenario. The other angle, if China really want to depreciate the yuan, which is the scary part, they may be talking about the basket, because the yuan basket has been rising this year. This is because the rest of the Asian currencies, especially Indian rupee at record low, the peso at record low, basically the basket might be too strong. So if China really want to go against, counter the trade war, the trade tariff, they actually might want a weaker basket. But that would be scary, because if they want a weaker yuan basket, that means dollar yuan will have to shoot up even higher.
Do they have, I don't know, do they have the tools to okay, there's a big difference between letting a currency weaken and devaluing it, right? Devaluing the basket, that's another step altogether as well. Do they have a tool to devalue the basket, for example? How would they do that if that was the case?
They would have to start from bilateral. The easiest way is from the fixing. Say, out of nowhere, they could...
Dollar-China fixing.
Dollar-China fixing.
Okay.
And then, obviously, the basket will follow when we get a much higher fixing. And that could happen, because, for example, in 2015, 8-11, that's what happened. 2% depreciation overnight in the fixing, and that's what they could do this time as well.
How, though, are other countries likely to respond to that? Because I imagine the likes of India, for instance, Japan, I mean, no one's going to like seeing the yuan effectively devalued against their currencies.
I think at least what market would do for those economies, say Japan, South Korea, all the exporters, they're going to devalue the currency for them. Or we could say depreciate, if not devalue is too much of a strong word. Because everybody basically, when China moves, everybody, especially in Asia, will have to react. So all the Asian currencies, especially the won, even without the domestic political turmoil, will have to depreciate quite a lot. So we'll see the beggar thy neighbor theme coming back again next year, basically.
What about, separately dollar-yen, because there's been some news over the last 24 hours that maybe a rate hike is not very urgent at this point.
To be honest, if they don't hike this month, it's going to be January. Because when we look at the fundamentals, wages are higher, inflation all above 2%, whether it's core or headline, they just have to hike. They just have to keep doing QT. So it's just a matter of time for rates to go up. But whether the yen strengthens is another story because the rate gap is still huge. So the yen may not benefit that much from a rate hike.
Two separate things.
Yeah.
Stephen Chu, fantastic work there. Our Bloomberg Intelligence Chief Asia FX and Rates Strategist. Let's get the take from Mark Cranfield from our MLive team joining us out of Singapore. Mark, two separate things there. As Stephen was pointing out, one on the BOJ, one on the yen. Just your thoughts on both.
Yeah, thanks, Stephen. You've invited the currency war for next year. I'm looking forward to that. I mean, he obviously he's quite right there that the basket would be the way. If China wanted to be aggressive, they would have to do it through the yuan basket. But if anyone who says to you China is thinking about weakening the yuan, just look at what they've done this year. The yuan has been weakening all year, or actually for most of the year. So it's not a question of what they're going to do. They've been doing it anyway, partly in response to the US dollar. And it will be no surprise to anybody if they were to repeat something like 2018, when as tariffs come in, assuming they do, that they regulate their currency in relation to the amount of impact they expect it to have on their economy. So no one is going to be at all surprised with that. The tricky bit, really, overall for the rest of the world is the starting point. Dollar yuan, the starting point here is way above 7. Back in 2018, it had a 6 big handle. The yuan relative to the US dollar was much stronger in 2018 than it is now when the trade tariffs in the first round hit. So that's a different scenario for the rest of the world. That's why emerging markets are especially nervous about what might be coming down the pipe in next year as well. So that's a new thing that people have to deal with, and how far they calibrate the yuan weakness relative to other currencies. And that's partly why people are thinking about we might be at 7.5, 7.6, something like that next year. But I think you will continue to see it on a gradual basis. They'll continue to use the fixing to moderate the daily moves. So it's very unlikely. The idea of a one-off devaluation or something like that, that's a very serious step. And it would be completely out of character with the way the PBOC operates.
What about what we're seeing in Korea this morning, Mark? How are you interpreting the latest political developments and the direction that we're seeing in equities? Because they're still in positive territory, just a little bit.
What investors really want to see is an end to this back and forth between the president and the rest of the parliament. They really are hoping that this weekend will draw a line. Whatever is needed to be done with the impeachment process or something else, they're really hoping when they come into work on Monday, it's all behind them and they can start to look back at the relative value, which is pretty obvious in Korean equities here. Particularly if you look at the Kosdaq index, at one stage this year, it was down 32% from the high that we saw earlier in the year. That's a very significant fall for a pretty major index. It's actually, on a relative value basis, actually dropped below the MSCI Pacific index for the first time since the pandemic period. So on many measures, Korean equities are very reasonable in comparison to their peers in Asia. But people need to be confident that the nasty politics situation is at an end. They need to see that behind them. So pretty significant for investors here. What happens this weekend? They would like to see a clean slate, a line drawn under what's happened. If it doesn't, we could be looking at next week, could be looking at some pretty high volatility again in Korean assets, because people will not be happy that it's dragging on even further.
Mark, maybe just to change the page here, the couple of headlines overnight, one and all of the related, Elon Musk, first person to have a net worth of north of $400 billion. In fact, it's now closer to $500 billion. The S&P, we've had some forecasts coming out from strategists, maybe another 9-10% next year. We're on track for 30% here this year. Is that still the cleanest read? Structure-wise, passive investing, flows, correlation, all roads seem to keep leading back to the S&P, whatever, agnostic of what we talk about here, Mark.
We'll know when the top is in for American stocks, when Elon Musk decides to IPO himself. $500 billion for himself. That would be a pretty good IPO. I mean, no, seriously, it is getting quite crazy what's happening there. But you can see, people believe that what policies they expect to happen next year will be very supportive for American markets. And it's almost becoming a situation of you can't afford not to be involved in US stocks, because if you're looking at they just seem to it's like a juggernaut, keeps on flattening every other market in the world. You just can't be left out of it. But if you look at a company like Tesla, for example, it's probably become the most dangerous stock in the US market. It has sucked in so much capital since the US election, even though if you look at it, the amount of revenue it generates and the cash flows and things, it is not comparable to the other Magnificent Seven stocks. It would definitely be lagging those on that basis. So its outperformance is really pretty shocking. And you really have to keep your eye on that. If we see a sign of people losing faith in Tesla, that would be a very negative signal across the broader market. So yes, Elon Musk is very closely tied to the performance of the American market. And we also need to see how foreigners interpret the policies that do come in next year. If it satisfies them in their belief that, yes, it really makes American markets have an exceptional value, then yes, it will continue. But the minute they start to question the need for the US markets to have a premium over everybody else, there's a very long way for it to tumble. But not many people are going to take that bet right now. It's something you don't want to stand in the way of.
All right, that was our Bloomberg MLive strategist, Mark Cranfield, there in Singapore, and I'd love to see the subscription for an Elon Musk IPO. But just talking about his wealth and how much it's risen. I mean, just on one day alone, he added nearly $63 billion overnight. So as Mark says, where the US equities go, it's very closely tied to the fortunes of Elon Musk as well.
Yeah, I just need to correct myself. I left out three zeros. I meant trillion, not billion. So he's nearly worth $500 billion.
It is absolutely wild. All right, well, of course, it's that relationship as well between Elon Musk and Donald Trump and that focus on the inauguration. Nice. We know he's going to have a front row seat, but maybe who else could be front row is Xi Jinping. We've been hearing that Donald Trump has invited him to his inauguration. Will the Chinese leader attend? Which way is he going to RSVP? We'll have more details on that ahead. This is Bloomberg.
Right. Outgoing U.S. Treasury Secretary Janet Yellen says Donald Trump plans for broad-based tariffs on China, well, they'll hurt the U.S. economy and provoke retaliation from Beijing. Now, she spoke to us exclusively in Washington.
Many countries, when they're faced with unilateral actions of that sort, look for ways to retaliate, and my guess would be that they would do that. We have in areas of concern where I've expressed repeatedly concerns with overcapacity that is developed in Chinese advanced manufacturing industries and clean energy, semiconductors, and the like. We think it reflects active, large subsidies that are flooding the world with exports and threaten to drive our firms out of business in areas that we think are critical to our own future. We've put in place tariffs. Now, they're strategic. They affected $18 billion worth of trade, certainly not all of our trade with China. And we did it to make sure that China's actions don't undermine our own plans to support these sectors. But broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness of firms that rely on those imports. So we've taken a strategic approach, focusing narrowly, and a broad-based approach I have serious concerns with, as most economists do.
That was the U.S. Treasury Secretary Janet Yellen speaking exclusively to Bloomberg. And despite his threat of stiffer tariffs, Trump's reportedly reached out to Xi Jinping, inviting the Chinese leader to his inauguration next year. Let's bring in our senior editor, Bill Ferries in Singapore. And Bill, this is the most read story on the terminal so far this morning. Seems like a lot of people want to know, would he RSVP, yes or no?
I think there's close to zero chance of this happening, and there's almost no upside for Xi Jinping. It's quite possible Donald Trump has invited him. I don't know if it's a serious request or just kind of an olive branch, a way to start things off. But foreign leaders do not historically attend U.S. presidential inaugurations. And then there's a huge risk that Donald Trump will say something during his speech, whether it's announcing tariffs or making a joke about China, that would put Xi Jinping in an extremely uncomfortable position. This is, after all, President-elect Trump just made a joke in the past week, calling Canadian Prime Minister Justin Trudeau the governor of America's 51st state. Imagine doing that to Xi Jinping when he's sitting in the front row of the stage in front of you. So I think, listen, it might be a nice olive branch. It might be a way to start things off. I'm sure the Chinese are going to look at a way to politely respond to this if the request was made. But I don't think Xi Jinping will be attending the inauguration on January 20th.
Yeah, and Bill, I guess to your point, there is a daily Ministry of Foreign Affairs briefing that we might be looking ahead to, that they might use that as a gauge, I guess, or as a way to somehow politely decline. But Bill, there's a literal invitation. There's also the symbolic part of it. And does this open up the door really for, I guess, to find common ground? We keep talking about how they're so far apart. They're strategic rivals as they are. But, are we sleeping on warmer, perhaps relatively warmer relations between the two here because of this?
Yeah, I mean, I do think there's a lot of potential in this, and I think probably the only way for the Chinese to respond is in a polite way, and to use that hopefully as a door to have some talks. If you remember the start of the Biden administration, it was very early on in Biden's term when he sent Anthony Blinken and some of his top officials to Alaska to meet with some of the top Chinese diplomats. That didn't go very well, but I think leading into it, there was a lot of hope that, hey, at least we're starting off this new presidential term with talks. I think that's the way to look at it. But I don't expect to see Xi Jinping sitting in the Washington cold outside on January 20th, potentially not being able to respond to Donald Trump's speech about him.
Yeah, the excerpt from this report out of CBS, and I guess just to bookend this conversation, Bill, State Department records dating back to 1874 show that a foreign leader has never attended a transfer of power ceremony. So I guess that closes the chapter to this, or the book to this story. Bill, thank you so much for the firm take there out of Singapore, our senior editor, on this invite. Right, up ahead here on the China Show, Bloomberg Intelligence is out with a list of the top 50 companies to watch next year. We discuss why one specific aluminum maker has actually made the cut. This is Bloomberg. Welcome back. You're watching the China Show. Our team at Bloomberg Intelligence has compiled this list of the top 50 companies to watch in 2025. That's out of the 2,000 companies that the team follow from across the world, across different sectors. Now you're looking at some of the companies that have made the cut from the Asia Pacific region. Here to talk about one specific company, China Hongqiao Group, is Michelle Leung, our Bloomberg Intelligence head of Asia Metals, Mining, and Sustainability. So, yeah, tell us about why this company in particular.
Yes, so China Hongqiao is actually China's largest aluminum smelter. So in terms of output, it accounts for like 8.3% of global output. So it's huge. And then we see three catalysts coming in. First, industry-wise, we think aluminum price is likely to rise in 2025. One reason is because it's likely to turn into deficit. And of course, Hongqiao is being the largest aluminum smelter in China, so it's very well positioned to capture the growth. We're expecting its earnings to up by 60% in 2024 and then another 11% in 2025. So momentum has been really strong. And secondly, is China Hongqiao, it has a very high percent of hydropower-driven capacity. So what's good is it leads to a lower than peers emission per ton. So in 2025, what's happening is Chinese government is planning to include aluminum in their carbon trading system. So the more polluting companies tend to pay a higher carbon price. So as a result, given that Hongqiao has a lower than peers emissions per ton, it's likely to stand out with a lower carbon cost. So again, it's put it in an advantage. And thirdly, we expect its margin and profits to stay above peers, mainly because of its bauxite self-sufficiency. We are calculating it as to reach at least 80% in 2025, as compared to its peers like charcoal is only 68%. It's very important for its cost control, and it put it in a lower than peers cost structure as well. And also we see new income streams coming in. First is recycled aluminum business is set to ramp up, and in this side we are seeing a strong demand coming in few years. And secondly is investment in Guinea. There is the world's largest iron ore mine that it has invested. It is likely to contribute more income as well.
You mentioned the outlook for aluminium prices for next year, and you're positive on that. Is that sort of a direct correlation then, high aluminium prices impacts positively profits for smelters?
Yes and no. Of course, higher aluminum price is good for the profit, and which we are expecting their profits to expand in 2025. But also we have to look at the cost as well. Alumina, which is the major feedstock of aluminum process, is the key. So what's been happening is that alumina price surged by over 70% this year. And in terms of the total cost, it jumps from 38% in 2023 to over 50% in 2024. So it's a very large factors to look at. So what's the good news is we are seeing that the supply of alumina to expand in 2025, which could possibly drag the price lower, so which means lower cost for the aluminum smelters. And we also expect to see it turn into surplus, so that would literally give a higher profit to the smelters.
All right, that was Michelle Leung there, our Bloomberg Intelligence Head of Asia Metals, Mining and Sustainability. And you can read the entire Bloomberg Intelligence list. Subscribers, go find that on your terminal. It's also available on Bloomberg.com. We will have plenty more ahead. This is Bloomberg. It's 11:29 a.m. in Tokyo. Japanese markets just about to go into their break. Big focus on the timing of when the BOJ is going to be hiking next. We had some exclusive comments coming through from BOJ officials saying that maybe December wasn't going to be sort of the base case. And of course, it kind of comes down to, okay, is it December? Is it January? But now we've actually got a new survey out saying that indeed the first month of 2025 is now the most popular timing for the next hike.
Yeah. So if you're making a trip to Japan, and many are actually, right, coming up to the Christmas holidays, don't take this as investment advice, but maybe change your money at the airport and not now. No, actually, don't change your money at the airport. They have horrible rates there.
I think you can find better ways than changing at the airport.
Don't wait till the last minute is what we're saying. There we go. Or just save money. Don't go. Okay. Asian markets, 0.7% to the upside. A lot of that is really down to the tailwinds coming through out of Japanese markets. There we go. In terms of sector groups, most sector groups are higher. You have IT top left, top row. Some weak spots coming through. Interestingly, I think that one of the tailwinds too on the macro front is really the weakness we're seeing in the U.S. dollar, and certainly an inflation print out of the U.S., which didn't give us any nasty surprise. In fact, it came in bang in line with estimates almost across the different metrics, effectively cements, and hopefully that remains the case, that we don't get any sort of shockers between now and the next Fed meeting, that rates are coming down next week, and that rates will trend lower going into next year. I think it's 3 to 4 cuts price between now and the end of next year. Now, what does it mean for debt issuance? What does it mean, this recovery? And let me bring in the Chinese story as well, that, you know, this pickup in activity we're seeing out of China. This time yesterday, we were speaking with Lena Choi, the Associate Managing Director at Moody's, and we asked her really about the trends they're seeing in terms of debt issuance this part of the world. Have a listen.
Onshore funding market, whether it's the bond market, whether it's the bank loans, have been quite supportive, has always been quite supportive. Interestingly, in the last 6 to 8 months, we have already seen some highly rated POEs already tapping the offshore bond market, and with also very reasonable rates.
And yeah, as they just noted, their activity has been picking up. And with U.S. inflation, we just talked about this overnight, it's all but really giving us a rate cut, or at least a window for the Fed to jump through that rate cut window next week. It might just provide that tailwind for more offerings or debt offerings to come amidst lower rates. Let's get the outlook right now with Citi. The bank is currently Bloomberg's top-ranked bank for G3 currency bond issuance. Rishi Jalan is head of their APAC debt syndicate and joins us out of Singapore. Well, Rishi, good morning, and thanks for coming on the show, taking the time. Before we talk about next year, there has been a pickup recently in volumes. Just help to set the stage for us. What's been behind? What are the catalysts that are behind this pickup in issuance?
Yep. Thanks, David and Annabelle. And again, thanks for having me back on the show. It's a pleasure to be here. So, look, I think if we take a look at how 2024 has been for Asia, we've seen volumes grow about 35%. I think it's coupled with two things. One is, of course, a view interest rates are going to come lower, but also given how tight credit spreads are in Asia. If I dissect that volume growth that we've seen, 50% or so has come from financials, about 30 to 40% from IG corporates, from sovereigns and policy banks. But very interestingly, there's been 15% that's come from high-yield bonds and corporate borrowers in the region, which, if I put that back to 2022 and 2023, there was less than 5% if the overall pie that went into high yield. So from our perspective, clearly a requirement and demand from the investor community for higher beta names has driven this volume. And I think we're quite hopeful as we get into 2025 that this growth will sustain.
Right. I think the number you're attaching to that is 25% going into next year as far as volumes go. Just help us understand what goes, what's behind that number.
Yeah. So we've estimated next year's volumes to be at 225 billion, which is about a 25% growth. This is ex-Japan and ex-Australia. A couple of factors. Clearly, a continued lowering of the dollar interest rate environment, credit spreads continuing to be tight, easing out in some geopolitical tensions. We'll have to see how that plays out in Q1. But it sets the stage for, quite frankly, a very conducive market. If you look at the redemptions for G3 bonds in Asia for next year, we're at about 260 billion. So even at 225, we're still going to be net negative in terms of supply. So from the bonds that investors are getting back to what they have to put in, new cash, there's still going to be a deficit. So that's going to drive higher demand, higher growth, a better execution. And as a result, we feel issuers will be quite proactive in going into the market next year.
You mentioned 15% coming from high-yield issuers. Do you see a greater proportion into 2025?
Yes, I do. And the reason is twofold. One is some of the default risk for Asian corporates has come down, especially if you look at places like India, ASEAN, parts of Australia as well. You are seeing a lowering of default risk. That has led to investors wanting to buy and take risk for high-yield bonds, right? And you take somebody like Vedanta, who we've done $2 billion for in the last 3 months. Great credit story on an upswing, but a name that investors want to buy into. Similarly, in Japan, you've seen names like SoftBank and Rakuten get great transactions done, decent sizes, but investor demand continues to stick. And as you've seen them come back 2 or 3 times this year, investor demand hasn't faded away. So with that backdrop in mind, for the right names, I think as we get into next year, we will see that high-yield bond volume pick up.
Just to pick up on that too, do you have any insight on currency preference, for example, dollar, yen, euro, what that split might look like next year? And are you also seeing any trends as far as the maturities are concerned? Are you looking at shorter, or are things trending longer at this point?
Yeah, that's a great question, David. So two things on that. One is in terms of currencies. Amongst the G3 currencies, dollars continue to dominate Asia. It's the most liquid and deepest pool of capital in the world. But when you look at, and this is very specific to Asia, when you look at the local currency markets, we have lost a little bit of volume to places like the CNH dim sum bond market or the Aussie dollar market, which have grown between 30 to 50% respectively. A lot of how that transposes into next year will depend on central bank policy divergences. And if you see the dollar rates come down fairly meaningfully, the treasury yields, you could see a lot of issuers wanting to go back into the dollar market and skip doing the local currency market. And it just comes down to pure pricing arbitrage. Right now, local currencies for some of these borrowers is more attractive than G3 and dollar debt. But that could reverse very easily as we get into the new year. In terms of tenor for Asia this year, it was interesting to see a lot of the supply was actually between 3 to 5 year tenors, 50% almost, which plays to the interest rate volatility that we're seeing on the dollar side, but also gives you a sense on where Asian investors are in their mindset of duration risk. That said, some of the recent trades, and you would have seen us take out Alibaba on the 10 and 30 year, even some of the high yield corporate borrowers, 7 years plus, have performed exceedingly well. And if you look at their performance in secondary market, you'd see that they've actually rallied and outperformed the short end of the curve.
Rishi, I was wondering whether we saw sort of a pickup in issuance toward year-end with companies perhaps looking to get ahead of any sort of geopolitical risk next year with Donald Trump back in the White House. Do you see that complicating the outlook for issuance?
Annabelle, it's a great question, and I think it really depends on sort of the policies and tariffs that are put in place. It's tough to really predict that. But yes, I think a surge in borrowing has been twofold. One is the geopolitical risk that lies ahead, but also just given the overall rate environment that we're in and where spreads are. If you take a look at the iTraxx investment grade spreads, we're at the tightest level in the last 5 years at about 69 basis points, right? This is just a broad measure of how secondary is performed in the region. So when you couple that together, yes, there is geopolitical risk ahead. There's some pre-financing that's being done to get ahead of next year's funding requirements, for sure. But it's not the only reason why we've seen that surge in volume. You take a look at the use of proceeds for some of the China tech names, it's gone down to offshore refinancing. It's gone down to share buybacks. These are opportunistic, in some way, but also necessary in order to refinance existing offshore debt. So I think, long story short, I would say the volume has been more than expected. I wouldn't necessarily only contribute that to, the geopolitical risk that we could see next year. It's just more, overall corporate financing requirement that issuers have at this time of the year.
Rishi, no conversation about debt capital markets would be complete now without me asking you about private credit. Maybe it would have been complete 14 years ago when we were at school together. Maybe not so now. How is private credit, carving out your time right now in your job?
Yeah, David. I would say on a day-to-day basis, we're spending more and more time speaking with private credit investors, looking at issuers with situations that are relevant to the private credit market. There are a few things here. One is, from a industry standpoint, there's some issuers, let's say ESG-sensitive issuers, who may not have access to the public market, given how public investors have changed and become more strict with their financing mandates. But these issuers could have, for example, the ability to finance bespoke sort of private transactions, private placements in the private credit market. Another example would be issuers who need flexibility with covenant packages, flexibility with tenors matching specific liabilities and assets. So when you have these situations, the private market actually ends up being a little bit more efficient for these issuers. It gives them a bit of leeway to grow, to be able to get EBITDA up to a certain level before then moving on to the public bond market. The other place that we find issuers going to is where you have requirements at different parts of the capital structure, so not necessarily at the senior level, but subordinated, mezzanine, etc., which again, becomes more efficient having a bilateral conversation or a club conversation with 3 or 4 investors on that situation. So from our perspective, our pipeline's building. It's a big focus point for us getting into 2025. And, bright spots, including ASEAN, India, Australia. I think we've seen and we know about the transactions that have taken place there. But I would say that to a large extent, we would expect to see more coming in from the private market as issuers remain focused on raising debt and then also having different options apart from the bond and bank market.
All right, really great insights there, Rishi. Come back and join us in 2025. That was Rishi Jalan, their head of APAC Debt Syndicate at Citi in Singapore. And coming up, why the weather could be shaping up as the next geopolitical flashpoint between the US and China. We'll have details on that ahead. This is Bloomberg.
All right. Apologies for that. Inside baseball here. Let's talk about China's top markets watchdog here, ordering Pinduoduo, and this is a big news, of course, overnight, to fix this refunds first policy, which, if effectively just a background here, allows customers to claim funds without returning the goods. Catherine Lim out of Bloomberg Intelligence has put out a reaction piece to this. Catherine, I have to say, this dropped right during the pre-market on Wednesday in the U.S. We did see some downside, not substantial as well. Mm-hmm. Did the fallout from this surprise you, and should we be concerned?
Do you know what? I think it's a mixed bag. It did surprise me that only PDD was singled out. Clearly, they started this about a year ago. So, they've got to fix it. And really the wording of it, the government is not really censoring them, telling them that was the wrong thing to do, but really telling them to fix a sector-wide, policy. And again, Alibaba, JD.com, Douyin, they've all jumped on the bandwagon of this. In the last couple of months, they've actually refined it because merchants, third-party sellers, they were just, struggling to meet with the refunds without the returns of their products itself. And it is really killing their profit margins. So I think, this is actually a good, turnout of events for the sector, maybe less so for PDD, given that they have to fix the problem. And it does mean their gains in China e-commerce market may actually slow down from before.
And as you said, this is PDD started this with this sort of aggressive returns policy. So do you think by putting a lid on it and making them stop, is that going to be something that's interpreted as a positive for Alibaba and JD.com?
Now, Annabelle, we'll have to see whether we're going to see them stopping this, because I think the entire the push towards this then was that they were trying to get merchants to act more responsibly in terms of fulfilling orders and making sure that, products qualities was what the shoppers had originally thought they were getting. So it started off with good intentions, and I'm not sure whether, we will see a full stop to this. Again, let's see what are the fixes that PDD will put in place. What it does mean then from the sector is that, all the refunds that's going to cost e-commerce companies money, we're going to see less of that, which is good for margins.
All right, that was our Bloomberg Intelligence senior analyst there, Catherine Lim, and shifting to a different part of China now because they're investing heavily in climate research, potentially putting the country on track to become the world's next weather superpower. Our weather reporter, Mary Hui, joins us in Hong Kong this morning. And why is it that focus that we're seeing now shifting to weather and looking to maybe have domination in that space as well?
Well, China wants to be a weather superpower. But let's talk a little bit about what a weather superpower actually is. The US is one. It has long provided a lot of data and models to countries all around the world that depend on US data for a lot of its climate modeling, weather forecasting. So the US does a lot of that. It's at the forefront of a lot of this research. It trains a lot of forecasters, and it has a large role in bodies like the WMO, the World Meteorological Organization. Now, China sees this, and as a rising global hegemon, it wants to take take on some of that role that's befitting of a global superpower. And so that extends to the weather domain because it's so relevant to all industries, all sectors. And if it wants to advance its own interests, safeguard its interests around the world, and push its own vision of the global order, then the weather space is really critical for that. And it's also a way for it to gain soft and hard power through weather.
Yeah, I mean, talk a little bit more about that. You know, one wouldn't normally think the weather is as central to forming strategic, and to your point, national security strategies moving forward. But why is weather so important?
So if we look at, for example, how intertwined for so long the weather and military operations, national security considerations has been, you really do see how closely linked all of these sectors are. So, for example, if we look at military operations where you have to plan when to, say, fire a missile or when you can advance troops or not, that is very much tied to weather forecasts. Moving away from military matters, maybe just even logistics of when you can move commodities, whether you can send shipments of oil or LNG gas around the world, that's very much dependent on weather. And just being able to have that global view and also then to have other countries use your own data is a way to both assert influence and also have some form of leverage.
So how does it look practically speaking? Like what would be the symbols or signals that we'd look for China becoming a weather superpower? Is it having that data, or is it having the technology? Is it influence in international bodies? What does it look like exactly?
All of the above.
Oh. Check.
So, for example, we saw at COP29, the recent climate conference in Azerbaijan, China announced a splashy investment where it said it will spend more money on advancing early warnings for countries around the world for weather hazards. It's committed to training over 2,000 forecasters from around the world to get them up to speed in advanced techniques. So all of these ways, right, in which China now wants to provide these services. It's definitely a show of goodwill. It's good investment, but also undoubtedly, as WMO's regional director told us, it's also very much about trade and influence in geopolitics.
Mary, fantastic. Thank you. Our weather reporter there, Mary Hui. Let's get to some other financial stories that we are tracking this morning. So Bloomberg sources say the main owner of U.S. chocolate maker Hershey has rejected this takeover offer from Mondelez. Now, Hershey Trust has roughly 80% of the voting power at the company. We are told it turned down the bid as too low. Mondelez, meanwhile, has approved a stock buyback, of up to $9 billion through the end of 2027. Now, Bank of America has promoted 387 employees to managing director. That's 16%, that's 16% more than last year's total. Now, more than half of those elevated to the senior role were women or people of color, marking the fifth year in a row that historically underrepresented groups made up the majority of the class. Now, BofA has also named, or BofA has named, 65 new managing directors to its global markets business. Right, we'll take a look at markets just ahead. This is Bloomberg.
Two incredibly big policy sort of pivots. One has been in September when the government have said, right, well, we want to deal with the property. It's going to take time. The market ran very, very hard on that, has pulled back sort of a third. And then we've had this new news from the Politburo meeting on Monday where they've said, going to be loosened monetary policy. We haven't had that for over 10 years. And also unconventional fiscal policy. Now, we don't know what that means, but if those things come through, you will get a very, very big rally in China.
I don't think the round 2 stimulus from the Central Economic Work Conference will be enough to reflate the Chinese economy. No. We think 2024 was the year of understanding the beginning of reflation in China. But it's going to be a long, long battle. It's going to take several years because 2024 is just understanding deflation is a bad thing. They made the pivot since September.
Yeah, just some of the parts of the conversations we've had here on the Chinese market economy and the outlook, which we could get more clarity on, of course, today with the paper, of course, on the Central Economic Work Conference. The document is what we're watching on for today. Right, as we await that, very quickly, Broadcom suppliers on the up. That's really on the back of this report on this Apple AI chip. That's number one. And number two, energy stocks. And the big news, of course, overnight was OPEC delivering its deepest cut yet this year. And I think they've done this successively since about June, if I remember correctly. Suffice to say, the demand for oil going into next year is wanting, and hence this drop, of course, across oil as well. Do we have that? Thank you. There we go. Very nice.
Yeah, well, I think actually, and even against that, OPEC's forecast is still actually higher than a lot of others in the industry. So yes. Suffice to say, not a great outlook there. But of course, we've been speaking about central banks this hour. It's a very big week for central bank decisions. The ECB is going to be one of those, and we're going to be following that decision live. We've got the news conference as well with President Christine Lagarde. But that is it for the China Show. Insights is next.